Good day all. Ira Epstein of Linn Associates with your financial market wrap-up. And this wrap-up's for Monday, the 3rd of February, 2020 at about 4:40 p.m. Central Time. So today we saw better factory orders, but we still are dealing with the coronavirus. And the CDC apparently is going to ask for emergency approval to have hospitals and state authorities do tests on patients without sending them to the CDC for analysis there. I think that's very important. There's 11 known cases so far of suspected coronavirus in the U.S. And now if they can get ahead of it, I think that's the idea. You know, whether we hear eventually that this is peaking or somebody's finding a virus for it, that's what the market's waiting on. But until that happens, you have markets like the energy market that just is crashing. No other word to say, 20% decline there already. Copper market's down about 10% for the year already. So you're looking at what these markets are doing that use factories, right? The factories use these products in China specifically to make other products. Now, we did expect that the Lunar New Year would be there, but now we're hearing further delays, and we're also hearing at the same time conflicting reports that there's still the open orders of some factories reopening in certain provinces in China, February 8th, 9th, or 10th. Schools, in the meantime, in many areas won't open until March. What's the reality? You're going to bring a room full of 1,000 employees in a factory and have them there? You're going to have masks? The answer is yes. I know that some of the factories have been ordered to have masks on hand, 2 of them for each shift of a worker. So there's a lot of new news going on, and obviously China wants to get itself back to as near normal as it can, as quickly as it can. So let's take a look at what the markets are doing. We had an update today. You were up about, just shy of 0.67% off this bounce, the break that we've had. But is it just a dead cat bounce? That's what the market's going to look at. You have a Monday rally. You've always been nervous about that Tuesday break. If you take out yesterday's lows, the question is, does the market grab any traction and make a run for this low? Now, if you'll remember, this low, if I'm correct, was the low that the market made on that the day that we saw the Iranians attack us in Iraq. So now the question is, does it go through that break low? Because the market hasn't done that since that point in time. When I look at the chart, I don't see a trend. I have a market that's got a higher high and a lower low. It had an outside day down on Friday. I mention that because we do the weekly charts on a Friday. But Friday saw a big break in this market, and one of the things that would be positive is taking out that day's high either today, which it did not do, or on Tuesday. Barring that, if you take out that low, I just have this is an area that I'm looking at that point, that low from that Iranian day of the attack. The market has got biased down because it is staying under the 18-day average of closes. And if you'll notice, each of the past 4 or 5 times that it's gotten up to that number, it's failed against that. What about the downside? Well, we also got to say to ourselves, look at the Bollinger Band. I'm going to come back here because now you can see it crystal clear. You come down, didn't hit it this day, but you did hit it on Friday, bounced away from it today, and now the question is, because you've got support there, can the market accelerate, or is that going to hold the market? Don't know. The chart's not giving us an idea. What I can tell you is you're oversold, finding support against the lower band with resistance at the 18-day average of closes. In the NASDAQ, it's a very similar story, with the exception the market's not going to the upper Bollinger Band or bottom. It's stuck at the line in the sand, as I call it, that 18-day average of closes. Going home, you have upside bias because the market closed over the 18-day average, momentum pointing down, and no trend. You got a higher high, lower low. Market, which I think makes sense. These markets are confused. They're trying to figure out what to do next. In the Dow, the trend is down. You've got a pattern of lower highs, lower lows. But just like you did what I was showing on the other chart, here's the market last Wednesday. You still had the pattern of lower highs, lower lows. You'd rallied to the 18-day average, failed there, went down, made an attack. You got down to 28,432, just above that the lower Bollinger Band. You hit that band on Friday. Often that's where the first support is seen. You got a bit of a bounce today, but not enough for me to tell you in any manner this market's bottomed out in anything there. It's oversold, finding support at the Bollinger Band, and I wouldn't be surprised if resistance is still the 18-day average. Let's also look at the other side of things. If you were to get a big rally, you would not get a pattern to trade. You'd have, no matter what you do, a lower low and a possibility of a higher high. In the Russell, the trend is down. You keep hitting the lower Bollinger Band. It's called running it. The market, though, is very oversold. It's working towards major support at the 100-day average of closes, which is 1604. If prices really let go, the 200-day might come under attack as well. But right now, the 100 is the most I'm looking for. In the VIX, the question is, are the pros selling calls here, hoping to get a pullback to the 18-day average? Now, what did happen, there is a positive right here. I want you to look at the 18-day average. It did get over the 100, right? Well, the positive there is not bullish for the stock market. It's entering an uptrend in the VIX. That's what the crossover is saying. And that puts, if this market goes higher, pressure on stocks. That's the theory. Certainly volatility's come back into the market in a major way. In the T-bond market, embedded reading, until that's lost, I'm expecting the pros to be buyers on pullbacks, selling out against the upper Bollinger Band parts of the positions and using trailing stops on the market. And I see the same thing going on in the 10-year notes, and I see it in TLT, because in my Spider ETF video, I was talking about that today. And you can see, you break down, you go back to that Bollinger Band, and you back away from it. But that's a bullish pattern, not a bearish pattern. We then look at the dollar index, and let's go back, if we could, to Friday, again, because we did our weekly charts. This pullback did not take out this break low. You can see that you made your first attack in a long time of the 100-day in green and the 18-day average of closes. Now, what else is happening? Tonight, the 18-day average got over the 100, so that's a bullish sign still for the dollar index. The resistance is the upper Bollinger Band. Could this chart turn bearish if you didn't take that out and you took out 97.16.5? And the answer is yes. As long as you didn't take that out, you could end up with lower highs and a lower low, putting into play the lower Bollinger Band. You have divergence in this market. While the trend is up, momentum is pointing down and the bias is up. Eurocurrency, the battleground's the 18-day average of closes. Now, we lost the embedded reading. When you lose the embedded reading, it often means price and the 18-day average make a run at each other, and I think you can see that that got very close. It didn't quite hit it. I think it hit 56, and the upper 18-day average is 56, and the high this day was 112.50. So you're right in that area. We'll see what goes on with it. But right now, I don't know who's controlling it. You're oversold, bias down, trend down, but you're not getting any traction to the downside. In the British pound, Boris Johnson is again telling the EU, you either get your act together or we're just going to leave no treaty deal. I think that's a lot of bluster. It's a big trading partner to just be telling that. But in any case, you got higher lows, higher high. You hit the upper Bollinger Band. And I know everybody thinks when you get up and you can get over that band, you're going to run. Okay, I don't. I think the first time you hit it, it could be a trap. And today, there's your trap sprung. So I teach people, you come out against those. Now, eventually, you're going to get a breakout of this sideways action. There's no question, and it'll do it when it's oversold or overbought. I know that. It's very typical the narrower it gets. Momentum is down, bias is down, trend is up. The chart's a mess. In the Japanese yen, if we come back and we look at the market on Thursday of last week, which is the last time we did a daily chart, we had higher lows, higher highs. Wherever this Bollinger Band comes in for Friday, I'll look for resistance there, be it today. Market made a run up on Friday, got to 92.54.5. The Bollinger top was 92.49.5. That's where I think pros take some money off the table. Yes, it could get up to the 100-day average or higher, but it's a percentage play. And all that happened today is you backed off 30 points or so from there. You haven't broken the trend. It's up. The market is overbought in a resistance area. In Bitcoin, I have no idea why all of a sudden they were saying today, I was watching some of the different stations and they're going, Bitcoin ran up today. I was watching something with Terry Duffy, the chairman of the CME, he was on, I think, Bloomberg. I don't see it up big. It's 30 points. It's been going up. We've been talking about the halving situation. It worked since the beginning of the year, and that's when the traders started buying this market. And that I can see. It's gone up from the 7,400 level up there, but you're in a resistance area at this point. If you lose the embedded reading, which has still got an 80 reading, but if it loses it when it reopens, you could be setting up price in the 18-day average to make another run at each other. Again, in the background, you're going to have less supplies. You got to keep thinking about that. In the Brent, this is April versus April crude. I don't know why it dropped that much. I'm not sure that's correct today. But let's go to this chart and get a feel. Look at how you're breaking down with an embedded reading. Market's got problems. Look at WTI breaking down. Now, you were down 140 points today in the April WTI, and you were down 181 points in the Brent. So I don't think this is right. I think the chart's wrong. I don't create the charts, but you only lost 40 points on the spread. Why would it go to 417? So I do think something's wrong there, and it'll probably correct itself when the markets reopen. Always be, look at individual prices. Just because it looks that way, I always double check things. And I can't tell you how many times I look at these and I go, is that right? You've heard me say it. Gasoline, still breaking down. Now, if it takes out this old low, my idea that the market had bottomed out here is wrong. Now, I know what would make it wrong. I don't think it's anything other than the coronavirus. I think the market would be in a normal time looking at an increase in gasoline and other markets, but you don't wipe off the coronavirus. I didn't think it was going to be this serious when I first heard about it, but it keeps picking up every day. You could take that out and you can see how cheap energy prices have gotten. Natural gas, you're trying a bounce, but you got an embedded reading. I think the pros are just selling this market on each and every rally, and they're still looking for lower prices, could be the lower Bollinger Band. Lose the embedded reading, I'll change my opinion. Now, as you know, you see all the technical information that I throw out. Well, we've got volumes 1 and 2 of technical indicators. And they cover all these different titles, chart patterns, chart trend lines, different types of charts. There's bar charts, area charts, which I can use, line charts, point and figure. I've done all these. I used to teach all these type of charting for different years. But you got to learn about them so you understand sometimes the jargon of the market. You don't have to be a pro in each part, but you should understand the concepts of what these different parts are. How do you get this from us? It's free. Just simply go to our website, sign up in our free offer. You'll see it. Call my staff tomorrow. They'll take care of you. In the meantime, I'm Ira Epstein. Have a good evening. I'll speak to you tomorrow.